Hi there, I'm Bijoy Sankar from ETMarkets, and I have with me a very special guest today. He's Ralph Acampora. He's a 50-year-old Wall Street veteran and the co-founder of the CMT Association, the global body for market technicians. Am I right?
Yes.
Welcome to the show.
Thank you for having me.
Thank you. Ralph, I'll ask you a very behavioral aspect of market technicians, right? What are the key behavioral aspects that you would like to underline in a market technical analyst?
I believe in being very simple, keeping it simple. And you keep it simple by understanding what you're looking at. First of all, you own the price. I do not own an indicator. I like to look at indicators, but my first chart is the price. And as long as the trend line looks strong, I'm fine. I'll look at the indicators second to see if there's any signs of deterioration. But as long as that trend is in force, I'm fine.
In technical analysis, price is as important as momentum and volume, right? And when you have some artificial factor like easy money, liquidity, and that kind of distorts momentum, how do you factor in all those aspects in technical analysis?
Well, as I mentioned before, I own the price.
Right.
The trend is very important to me. I look at those indicators to see if there's a loss of momentum. But it doesn't affect the stock price until that trend is broken. So I have a discipline. The trend's your friend. And yes, there is a lot of distortions out there, and you're going to have indicators that confuse each other, and they're going to confirm. You can't avoid that.
Right.
But you can follow the trend.
When we talk of technical analysis, it sounds like a plug and play kind of an instrument, right? But it requires a lot of discipline and a lot of practice to really get the wheels moving, right? But there is a new generation in the market who are people in a hurry. What do you have to tell them?
Relax. No, you're absolutely right. I've been doing this over 50 years.
Yeah.
And I got to say, I learned something every day, or I learned something that I have to reinforce that I picked up over the years. And again, keeping it simple is very important to me, number one. And number two, I get the question all the time, hey Ralph, you've been doing it for so many years, what has changed in technical analysis that makes it different? And I say to them, if you're longer term, you're going to hold a stock or a commodity for 6 months to a year, I don't think anything has changed. The momentum, the trends, and the tools that you use, fine. But on a very short-term basis, I think a lot has changed. With all the volatility in the market these days, with the algorithmic trades,
right,
that volatility has got to distort your work on a short-term basis.
So can you list out 3-4 more factors that led to a lot of readjustment in the models maybe you are working on?
No, I don't. As I said before, if I'm still talking intermediate or long term,
right,
I don't think that has a lot to affect the trend.
Right.
But short term, that's got to be chaotic.
Right.
Yes, and honestly, I don't trade intraday. I know some people that do it, and obviously some of them are very successful, but not for me. I'm being honest.
So when you look at the millennial investment environment, how do you look at the typical millennial investment environment in today's market?
The same as I've always looked at it.
Okay, nothing has changed.
No.
From your time to today's generation, the way they look at market.
The only thing that's changed is this thing. You have the market on here.
Right.
I showed everybody this morning my paper charts.
Right.
We did it 50 years ago by hand.
Right.
I think that was a little better because I could feel the market. But today,
but in
the
terms
data is at your fingertips.
But in terms of investing psychology, the people, this is a generation in a hurry to make money.
I don't think that's any different. Everybody's always been in a hurry.
Okay.
Every generation.
Right.
So it's some worse than others. But I'll tell you one thing. This generation, like previous generations, is going to learn a hard lesson. Don't be too greedy and too fast, because markets will come back and hurt you. We have to go through that cycle, many generations.
There is this perception that technical analysts don't care much about macros. How important is the macro element in that?
That's true. Some people say, well, I'm a classic technician and that's all I look at. I say that's fine, but I've been a teacher for many, many years. And I've been saying this for many years, that to really do quality research, you should start with economics. And when you have an economic opinion, then you go to the industries that do well in your economic opinion, your environment. Let's say you think it's a slow growth economy. Then you talk to the fundamentalists and you find the industries that do well in that slow growth economy. Maybe it's financials, and maybe it's technology. The third thing you do is do the quantitative back test. Okay, now that you've identified what you want and where you want to go, before you pull the trigger on your gun, look at the chart to see if it's going up or down, see if it's bottoming out or topping out. So to me, that's the whole process.
Right. Yeah. How important is the maturity of a market for your technical models to really work? Like if you, I don't know how seriously have you looked at Indian market? Do you think we have achieved that kind of a maturity for those technical models?
The liquidity, and I'm talking about in the United States with large capital stocks and even the small and mid-cap stocks, they're fairly liquid. When you get to the minutia, you get penny stocks. There's where your problem is. There is no liquidity, and I think you'd have to stay with the ones that are big and comfortable to trade with. I think, and again, it depends on the individual. If they are attentive enough and willing to take the risk, fine. That's up to the individual.
Right. So this long bull run in the US market is making people a little wary. What are your models saying about the market for next 3, 4, maybe 6 months, 1 year?
Okay. There are two ways to forecast a market.
Right.
First way is take all your information, fundamental, technical, quantitative, and whatever, and you have this data, and you say, well, looking at my research, I'm projecting 10% upside for the market. That's anticipating. The second way to look at a market or forecast is to react. And I have to tell you, I've been in this business 52 years, I have never seen such global conflict, whether it's the China-US trade, Brexit, Iran, North Korea. We have people in the United States who are talking about socialism. We have Donald Trump who puts out a tweet, anything could happen.
Right.
So if you asked anyone, honestly, what they think the future, no one knows. It's confusion out there. So what I do is I look at the market, and if it's starting to build up momentum, I react to that and I am long. If it does the opposite, and for the last couple of months, I've become more aggressive on the market. I advise family funds, and you know what really impresses me in the last month or two is the fact that the market globally is starting to pick up. Right. Germany, France, India, look at that. It's not just the United States. And not only that, I like the leadership. So I'm reacting to the market, and I am long. My money's in the market. My advice to my clients has been, let's be long. I sold some gold about a month and a half, 2 months ago, because I think that's counter-cyclical. While the market goes up, gold will pull back a little bit. And I don't know if it's 3 months or 6 months from now, I'll have to change my mind. But I'm going to react when I see it.
As they say, you can't really catch the market bottom, and you don't know when the top will come.
Well, you have indications of, but to catch the absolute top and bottom, I don't think you can do that.
Okay. It's always nice to talk to you. We'll
Thank
be in
you.
touch. Thank you so much.
Thank you very much.